Good evening, ladies and gentlemen. A very warm welcome to FSM Choice Awards 2021. This evening, we honor and celebrate the 11 unit trusts and 7 asset management companies that emerged top of the pack based on both sales and research analysis that place emphasis on the consistency of their performance and ability to manage risks. With more than 1,800 unit trusts available on FSM1.com from more than 50 fund managers, emerging on top is certainly an impressive feat. In addition to announcing our Choice Award winners, we are unveiling the new edition of our recommended funds list. Later this evening, we will be sharing some of the interesting updates to the list. We hope that both the FSM Choice Awards and our recommended funds report can provide you with a source of idea generation in building a globally diversified portfolio by the second half of 2021 and beyond. Tonight, you can also look forward to 2 panel discussions featuring key fund house representatives from Fidelity International, First Sentier Investors, UOB Asset Management, BlackRock, and Lion Global Investors. In these segments, they will share their insights into what brought about the success to the funds they manage and the direction for various key markets. For all event attendees, it is your chance to win our lucky draw. 4 lucky winners will win $200 worth of bonus units into an award-winning unit trust managed by either BlackRock, First Sentier Investors, Lion Global Investors, or UOB Asset Management. 1 grand prize winner will walk away with a total of $800 worth of bonus units into all 4 award-winning unit trusts from the 4 asset managers. How do you participate? Simply attend FSM Choice Awards 2021 and collect our secret codes that will be displayed on the screen at random times during the day. You can also spot them on our Event Live website. There are up to 5 secret codes to be spotted, so the more you spot, the higher your chances of winning. To enter into our lucky draw, you will need to be logged in to our Event Live page and be an existing FSM1 account holder. You have to spot at least 1 and up to 5 secret codes throughout the event. Then complete and submit the form with the secret codes and your relevant details, and remember to enter the same email you used to log into this event. If you have any questions, feel free to submit them using the Q&A feature on the event microsite. You can do so by clicking on Events Activities on the navigation bar and then click the Ask Question button under the agenda. We will be happy to answer as many as possible throughout the event. With that, I would like to invite Mr. Jean-Paul Wong, General Manager of FSM1.com, to give us the opening speech.
Good evening, ladies and gentlemen. Welcome to FSM1's Choice Awards 2021. Thank you to our investors and fund house partners for joining us tonight, and we hope you'll find the event insightful. The Choice Awards is a yearly affair where we recognize the best and most popular funds. From over 1,800 funds on our platform, our research team has shortlisted a grand total of 45 funds in the FundsPermart Recommended Funds Report. There are a few criteria that they look into, including, of course, the fund's performance. The fund has to be good, but not just for a short period of time. It has to consistently outperform over a period of 3 years or more. Second, it's also the ability of the fund to outshine its peers during not just the good times, but also the tough times. So the fund's resilience matters a lot. As the saying goes, when the going gets tough, the tough get going. My colleague Ting Yan from our funds research team will be sharing more later on. Finding the best funds is one part of the process. How do they fit into a portfolio that can help you navigate the volatility and achieve your goals? We always advocate having a core and supplementary portfolio here at FSM1. You'll be hearing from our fund house partners later on how to build resilient portfolios during the 2 panel discussions. The other important part of the Choice Awards is to recognize the funds that have performed very well in terms of their risk-adjusted returns. We also recognize the funds that have been the most popular in terms of sales and regular savings plans from our investors. And our investors get to vote for the Fund House of the Year award as well. One key thing at FSM1 is about how we can help you to invest profitably. This is something that is captured in our mission statement as a company. My investing journey began with funds 1.5 decades ago with a number of Greater China funds. Not the best way to diversify, but those were the only investment I had back then when I just got started. Over time, I've learned some useful lessons, and today my portfolio is a lot more diversified, and I have a number of funds invested across equities and bonds and across different sectors, including Asian equities, global financials, China, Asian high-yield bonds and emerging market bonds, as well as the Sing dollar-centric bonds. The most common thing about funds is that I use them for different objectives that I have. So, for example, I have it for my retirement planning. I also have it for another portfolio for my kids' education funds, and also for the shorter-term cash management part, where I want to beat the low interest rates on deposits as well as inflation. I'm happy to say that I expect funds to continue to be a key foundation in my portfolio in the future. I hope that you'll find our recommended funds report and the analysis and content from our analysts and our fund house partners to be of great value in your investment journey with us. Just this week, we have launched a new initiative called the FSM Investment Academy, which will allow you to sign up for investment courses with the trainers and investors we've been working with at zero or little cost. So this is all part of our plan to help you invest profitably. I'd like to thank all the winning fund managers and fund house partners who have shown great consistency over time to bring great investment ideas for our portfolios. Congratulations and thank you once again.
Thank you, Jean-Paul. We would like to kick things off with our first poll for tonight. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for poll number 1, then click on the Join Poll button. The poll window will be displayed on your right. Now, if you're all ready, let's begin. Here's a warm-up question. What does FSM stand for? I believe this is within the email address. So. Now on to question number 2. Which of the following are you most bullish on? Emerging markets, Asia ex-Japan, Japan, China? Which one? We would like to hear your thoughts. It looks like the majority of us are most bullish on China, followed by emerging markets and Asia ex-Japan and Japan. Okay, let's see what question 3 is all about. Have you heard of ESG investing? Okay, it seems like most of us are familiar but have yet to invest in ESG products. Question 4, are you invested in more equities, more fixed income, or an equal weightage of equities and fixed income? 80% of us are invested in more equities. That's very interesting. Thank you for sharing your thoughts with us. We appreciate that. And we will now take a short break before we head to our first segment of the evening, which is a panel discussion with panelists from Fidelity International, First Sentier Investors, and UOB Asset Management. Don't go away for too long, and we will see you again shortly. Welcome back. Let us now begin our panel discussion. Moderating this session will be Mr. Colin Low, Assistant Manager, Macro Research, FSM Singapore. On the panel, we have Mr. Christopher Wong, Client Portfolio Strategist, Southeast Asia, Fidelity International. Ms. Christy Goh, Director, Intermediary Business, First Sentier Investors. And Tony Raza, Senior Director, Head of Multi-Asset Strategy, UOB Asset Management. Over to you, Colin.
All right, thank you, Geraldine. So without further ado, let us begin today's panel discussion. So today's panel discussion will be centered on how to build an all-encompassing portfolio given our current investment climate. So I'd like to jump into the first question right now. So for the first question, I would like to get a panelist's view on today's asset allocation in the current investment climate. So I would like to direct this question to Chris as well as Tony. So in light of the market as well as economic developments seen today, as well as the COVID developments we see throughout this year, so how should unit trust investors position their portfolio between equity as well as fixed income? So maybe we can start off with Chris first.
Sure. Now, we always advocate having a balanced portfolio with allocation that suits individual investors' needs, circumstances, and risk appetite. Now, as at the moment, we are still currently quite positive on the global macroeconomic outlook amid a still very supportive monetary and fiscal backdrop. So it makes some sense to add a little bit, to have a slight risk tilt within portfolios. So for us, we are slightly overweight equities with a preference for more value, cyclically oriented sectors. And in fixed income, we have a preference for corporate credits, which to us has more value over government bonds, for example. And they are not less sensitive to interest rates movements in the short and medium term.
I would agree. I would add that I think usually when we make recommendations for investors, we do recommend thinking about sort of like a cycle approach. And so where we are in the cycle now is after going through a severe recession in 2020, we're starting an expansion cycle that is likely to last several years. And as such, then we do lean towards growth assets, which does mean carrying more equities than usual. And that also, given the fact that long-term expected returns are quite low for fixed income, that's even like on a structural long-term basis, we're carrying more equities. I would add, though, I think like Chris mentioned, within fixed income, we do continue to focus more on the credits, and we're carrying a bit more high yield than usual.
Right. Great answer, and thank you, panelists, for the insightful answers. So I think my next question itself is something that our investors would like to know. I think this is something of a high interest for our investors. So I'll direct this question to Christy as well as Tony. So what are some of the investment themes and opportunities that investors can leverage on in the second half this year and perhaps even beyond this year? So perhaps we can start with Christy.
Area which has not seen as much investor interest has been in Indian equities. You know, this year has been a really tough year for India, and if you look at the headlines, you'd be surprised to note that India's performance has been in excess of its better-known neighbor, China, right? And these are two large but very different markets. If you were to look at India from a top-down perspective, it's very chaotic, you know, there's not much policy guidance, but really they don't depend on that. They've gone through many governmental changes and they've still managed to grow from strength to strength. China, on the other hand, has a very strong top-down approach, which means that as bottom-up stock pickers like us, we almost have to think like the Chinese government, and that's not the easiest thing to predict over time, as you can see. So India has always been very self-reliant in terms of the companies that we invest in. So companies had to rely on themselves even during COVID environment. They had to ensure their employees were safe from COVID. They had to ensure that they had oxygen supply, makeshift hospitals in company guest houses, basically, right? If you look at other factors like capital discipline in India, it's far stronger because they haven't had the luxury of easy and cheap access to capital like, say, China would have, or a lot of other markets. And I guess lastly, as I end off, if you look at where India is in terms of product penetration categories, they still have a really long runway to go. And I think, it will be a market that will continue its growth traction for a good number of years to come if we pick the right companies.
So I would add that so our key focus is we think there's a growing big opportunity in Asia as a whole. So it's Asia fixed income, but even more so Asian equities. There's several points to it. We highlight that firstly, that on a long-term structural basis, Asia tends to go through long periods of under or overperformance. There was the early 90s where Asia strongly outperformed, the late 90s where it underperformed, the 2000s where it performed great, and then the last decade where it's been a strong underperformer. In the last decade, compared to the US, Asia's underperformed by something like 150%. And so there, on top of that, there's a lot of exciting mega trends in the world that we think that Asia's really positioned well for. These include a lot of the things I think everyone knows about, but it's things like, where the demographics and where all the millennials are, they're all in Asia. Where the growing middle class is, all the middle class growth in the world is coming in Asia. And in the past, Asian companies used to be sort of like contract manufacturers for the West, but now as we pour through the investment opportunities in Asia, there's so many companies that are well positioned to harness this. And so I think the underperformance of the last decade, we don't think it's going to continue forever. Asia right now isn't performing the greatest, but we think there's a big opportunity that's going to last for several years.
Great. Thank you, Tony, and thank you, Christy. So a lot of our investors have shown a great interest in Asia and more recently in India as well. So I think those are really good and valuable insights for our investors to hold on. So my next question will be on another hot topic that is occurring in recent years. So there has been a lot of chatters as well as talks within the markets on sustainability. So it's certainly an area that our investors would like to understand more as well. So I would like to direct this next question to Chris as well as Christy. So regarding sustainability, what are some key considerations that investors should take note of when attempting to invest in sustainable products? And also, what are your thoughts on greenwashing? So can we begin with Chris?
Sure. Maybe I start on greenwashing. So one can really think of greenwashing as adding a thin coat of sustainability to any fund. Now, the problem here is green itself has a very wide range of meanings, and sometimes investors can assume a certain standard where there isn't really a consistent standard across the board. So that's one problem. And the lack of transparency and sometimes a deliberate attempt by asset managers to put on the sustainability label makes it a bit confusing, and to some investors, it could just be a false front, right? So it creates a false front of sustainability, giving kind of sustainable investment a bit of a bad rep. Now, some considerations really on when considering ESG into investments, the best way to avoid being greenwashed is to do two things. One, to know the right questions to ask, and two, to do a bit of your own homework. So questions one can consider when doing private investment is, does your asset manager genuinely integrate sustainable investing into their process? So this should be incorporated into a manager's fundamental analysis, financial analysis, etc. So this is one part. Second is the manager engaging with companies, right? So how many meetings have he done? How many has he engaged with companies with, right? Number of meetings on sustainable issues, and were there follow-ups that have happened after that? And the third one is really, is your asset manager walking the talk? Do they incorporate these sustainable practices as well into their daily business practice? So these are questions one can consider when really thinking about who to invest with regards to sustainable investing.
Well, I guess adding some color to that, just the acronyms alone that's available in the market, you have Sustainable Development Goals, you have Responsible Investment, you have ESG. The headlines could be quite confusing for a lot of investors today, right? And you have benchmarks like Dow Jones Sustainability Index, which has British American Tobacco as its constituent. So if you were to not know better and invest in a fund that uses that as the benchmark, you could be investing in a tobacco company, and by no yardstick would we consider that as a sustainable business, right? And it's not just that. There's a lot of carbon neutral, talk out there as well. And the approach that we have is quite different. We don't want to invest in, say, a consumer company that consumes ton of plastic in their packaging and then plant 1,000 trees on the other side and say, I'm carbon neutral, right? Because technically they are. What we really want to look for is a company that has started to think about packaging alternatives using biodegradable products that's just better for the environment, right? So there's a bit of that greenwashing that's happening there. And we usually like to use ESG engagement as a way to understand management mindset a little bit better. So there was a situation quite recently where we introduced a private company to 2 semiconductor firms that we've actually invested in. And if you guys understand the semiconductor industry, it's a very water-intensive fabrication process. So what this private company has done is that they've managed to reduce the water intensity, managed to reduce the bottleneck in wafer fabrication as well. So as we followed up on it after the introductory meeting, Company A had actually moved on to having that private company meet with senior management and gone on to proof of concept in a matter of weeks. Company B, on the other hand, had basically told us, I'm sorry, we haven't moved on because we weren't sure who to forward this request to, right? But if you look at just the surface on their annual reports, it would be the same checkbox. We have done an introduction meeting with a private company that could help our water consumption utility. But the follow-up action speaks volumes in terms of which company is truly sustainable and thinking and acting through it, and which other company is just really doing it at a very superficial level. Yeah.
Right, great.
Can I add comment?
Yeah, sure.
So I think there's one consideration that I hear from clients that I don't think should be a consideration. I hear all the time, like, what are the trade-offs? I think that's the wrong direction. There are no trade-offs. Not only is it historically there's no trade-offs, but in the future it's going to be very dominant that those who are not making these considerations, that don't know the science of comprehensive accounting and what all these pollution costs are and how it affects the value of the company, it'd be like hiring a fund manager that doesn't know how to do dividend accounting because he hasn't learned the latest techniques. You need to hire fund managers that have learned the latest.
Great. I think that's all. The answers are very insightful for our investors. So let us move on to the next question. I think this next question will be an interesting one. So, and I will direct the question to Chris and Tony. So, what is one investment theme or idea that you consider as a dark horse within the next couple of years, say in the next 2-3 years, or perhaps even longer? So, maybe Chris can start.
Sure. One structural idea we like now is Chinese tech stocks. So not very long ago, they were actually market darlings. It's really fallen a lot out of favor, given recent kind of regulatory developments in China, right? And how it's really affecting some parts of the market at the moment. Now, we really, at this point in time, we believe some of these measures are really for the long-term health of the global Chinese tech sector as a whole, to increase competition, to make it a little bit more fair for the consumer. So we think long-term wise, this is an area that we still like. And value is gradually starting to emerge after kind of the correction we've seen for the last couple of months. But really, one has to be quite selective here still, to be very careful to invest in stocks, or companies rather, with a long-term foreseeable trajectory and managed by quality management who know what they're doing and ready and flexible enough to navigate the environment going forward.
So investment theme that I think is not very favored right now, but I actually think is going to have legs over the next several years, would be this whole idea about multi-asset income again. This was a area that did very well in a much longer cycle than we've seen in prior cycles over the last decade. And I think right now markets are sort of turning away from it because I think there's like a fear that bond yields are going to rise aggressively and inflation is going to make it less attractive. I think the reality is we're in a low interest rate, low inflation world for a long time. These structural forces have been around for 2 decades, and they're not likely to have just disappeared because there's some supply constraints. So I think I know we meet fixed income investors that need yield every day, and I think the way they're going to find it is by using combinations of portfolios that bring in high yield, that bring in dividend income, and that these multi-asset income, I think, is going to have legs again before long in this cycle.
Great. Thank you, panelists, for the insightful answer. So let us move on to the next question, which is also regarding another hot topic in the market right now. So inflation, like Tony mentioned earlier. So especially with the recent release in the US CPI numbers, I think the inflation concerns are beginning to resurface again. So my next question is regarding inflation, and it's directed towards Christy and Tony. So what are some sector, regions, or even investment strategies that an investor can consider in an inflation environment? So perhaps, Christy, you can begin first.
Yep, sure. Well, I guess in an an inflationary environment, the baseline is you should stay invested regardless of over sectors or which countries, right? But I think specifically to target inflation and in line with the pandemic environment that we've just come up from, one theme that has been recurring would be infrastructure. So we've seen Biden's plans, it started from Donald Trump and then Biden, but really infrastructure is a lot more than that. Very often when we engage clients on infrastructure as a topic, there's a lot of education involved because they think infrastructure, they think China, Vietnam, emerging economies, but truly where we need a lot of infrastructure investments is in developed markets because the governments are strapped. They don't have cash to refurbish or rehabilitate existing infrastructure. Now, if we think further along those tracks, companies and utilities, these are inflation-proof because they pass on the cost to users, right? Toll roads, inflation-proof. The contracts, the multi-year contracts that they sign with the government as they undertook these projects means that they can build in CPI plus as a factor into what they charge to end consumers, right? And if you think about the pandemic environment we've just come through, even the growth infrastructure assets will add a lot of value. Your airports are now at pre-pandemic levels in terms of volumes, not in Singapore, obviously, but across Europe and even in China, where domestic travel has resumed significantly. If you look at ports, cargo volume have come up quite a fair bit as well. So from both growth and income and stability to combat inflation, infrastructure is very well positioned moving forward into the next couple of years.
So I would add just a lot of the usual suspects. If an inflationary environment becomes stronger, then it's the usual things that stocks outperform bonds. It's sectors like the US dollar and gold tend to be strong. And then you also have sectors like property and commodities that do well. And if we truly get more of a reflationary type environment, those are the types of things we would be looking for. But I would still hold out that I think 1 year of some inflation numbers, I wouldn't be overly anxious about inflation yet.
Right, so thank you, panelists, for the answer. So before I close out the panel discussion, I have one last question for the panelists. So can you share more about your top funds' performance and how some of the recent market factors have affected those funds? So maybe we can start off with Chris.
Sure. Now, most of our Fidelity funds have held up quite well in recent market volatility. Now, this is supported really by our quality bias and our insistence on good bottom-up fundamental research. So examples of funds that have held up quite well in recent volatility periods are, like, for example, our Emerging Market Focus Fund, our Sustainable Asia Equity Fund, and our Asia Pacific Opportunities Fund. Or maybe let me just quote the last fund, the Asia Pacific Opportunities Fund, as an example. Now, what really has helped this year, our fund, is the bottom-up fundamental research, picking the right stocks, being flexible in allocation, and being contrarian in nature. So one thing that helped us was avoiding expensive technology stocks early part of the year. So market darlings then, like Meituan, for example, we didn't really hold most of those. So that helped on the downside. Now, we also picked up a number of quality cyclical stocks last year during the COVID drawdown. So that has also helped the recovery in the cyclical recovery this year. And third, bottom-up stock picking. So we had examples of a few good stocks which we picked a bit ahead of time before markets really realized the catalysts that were coming ahead. And that has also been a good driver of kind of alpha for us as a whole.
Well, very similar to Chris at First Sentier today, broadly our funds would have held up very well. I guess for investors who's been invested with us for a good number of years, you would have realized that we tend to hold up very well in extreme market conditions. A lot of our funds are very Asian-centric or Asian biased, which means we would have significant exposure to China. And last 2 weeks hasn't been the easiest markets for anyone over there. But thankfully, in all our regional portfolios, we've had zero exposure to Chinese education stocks. We've had very, very light weights to Chinese tech firms, like Chris mentioned. And we actually took opportunity on that front when the Chinese regulatory changes got announced in the market. We bought on dipped, we topped up some positions in names like Tencent, and that has fared much better since the announcements came out. So I think the litmus test question that we always ask internally is, if a stock fell by 20%, what would we do? Would we cut loss? Would we increase our position? I mean, if we are truly bottom-up, high-conviction stock pickers, then the answer should be we should be topping up positions, right? No one's going to go to a sale and say, you're on 20% discount, I'm not buying you anymore. That's really the wrong way about it. So I guess, bottom line is what we have in our portfolio are high quality franchises that remains we are highly convicted in, regardless of where the macro noises are coming through from. Yeah.
So similarly, I wanted to highlight our China A-Share Innovation Fund. I think as sentiments that have been echoed earlier, I think it's a really interesting space that obviously is getting hit with a lot of turmoil. I think the fund's ability to be able to get solid returns in a questionable environment, I think speaks to that innovation comes from a lot of different ways. It's not only a focus on tech companies, it's within the industrial space, within consumers. There's a lot of room in China to find exciting stories. I think it's obviously been a sort of tumultuous period with a lot of regulatory changes, but I think those that are able to manage this, and I think going forward, there's exciting opportunities.
All right, thank you all the panelists. So I believe today's discussion will be rather fruitful and many valuable insights have been gathered for our investors in this session. So once again, I would like to thank all the panelists for the valuable time. And with that, I've come to the end of today's panel discussion. I would like to pass the time back on to Geraldine. Geraldine, please.
Thank you, Colin, Christopher, Christy, and Tony. Let us now invite Mr. Cheng Jing Yen, an analyst unit trust research, FSM Singapore, to share about the latest edition of our recommended funds list that we are unveiling tonight. This means that you will be the first group of people to hear about the newest changes we've made to the list.
Good evening, everyone, and thanks for tuning in this evening to the FSM Choice Awards. My name is Xing Yan, and I'm part of the research team here at IFAS, and tonight I'll be running through with you the much anticipated recommended funds list for the upcoming year. So since 2001, our research team has been publishing the recommended funds report to help investors make informed decisions while investing. Given the wide and increasing variety of funds available for investors, this list should help to reduce some of the choice paralysis that investors may have, as well as serve as a good starting point in building a well-diversified portfolio. Our recommended funds span across equity and fixed income asset classes, covering global, regional, single country, and some sector-focused strategies. The list is updated annually to ensure that our recommendations remain current and relevant for all investors. In choosing the funds that make the list, emphasis is placed on long-term outperformance rather than short-term market conditions, which could change in the blink of an eye. So without any further ado, presenting the recommended funds list for 2021-22. So for the 2021 edition, we have a total of 45 recommended funds that have demonstrated their ability to deliver long and consistent risk-adjusted returns over long-term horizons relative to their peers. We have added 2 new categories, Asian property and Chinese bonds, with their funds being the Manulife Asian Pacific REIT and the Fidelity China Renminbi Bond. China's fixed income markets are steadily becoming more accessible to investors, and with value hard to find in global fixed income markets currently, it is a timely addition to the list. Property is also an attractive consideration as both a reopening and cyclical play, but also serves as a strong inflation hedge. Asia Pacific REITs have also weathered the COVID-19 storm exceptionally well, and investing through a fund provides a hassle-free, diversified approach to an attractive sector. In addition to new categories, there have been some fund changes in the existing categories as well, which shouldn't be surprising considering how volatile markets have been in the past year. 8 new funds have made their way on the list, in many fund categories that should be of great interest to most investors as well. So that leaves us with the question, how do I incorporate these new funds into my portfolio? So well, firstly, let us take a look at the Fidelity China Renminbi Bond Fund. Fixed income portfolios should achieve the goals of stable income and low risk to principal, but with rising rates and many fixed income markets trading at or near all-time highs, this is proving to be a challenging goal to achieve. However, Chinese government bonds remain one of the last fixed income markets that fulfills these requirements. There have been plenty of chaos in the Chinese high-yield bond market in recent times, but unlike their high-yield counterparts, Chinese government bonds are not exposed to that significant credit risk. Instead, they sit in somewhat of a sweet spot, providing decent yields without being overly exposed to credit risk. Significantly, they have also stayed free of the contagion affecting high-yield markets, registering positive returns on a 1-month, 3-month, and a year-to-date basis. In addition, this attractiveness is further enhanced by its low correlation to other key asset classes, making them an excellent option for improving diversification. Interestingly, they also exhibit low correlation to US 10-year Treasury yields, making it a good choice when most of the world is concerned about rising US inflation and rising rates. As China's economy grows larger, more investors are looking to gain exposure to its burgeoning financial market. While there have been steps taken to increase accessibility to foreign investors, Chinese investors are likely to adopt a measured approach, and therefore investors should view this as a long-term structural theme. The inclusion of Chinese government bonds in major fixed income indices may also drive further foreign participation in the future. According to a research done by BNP Paribas, between USD 200 to 300 billion would flow into the asset class as a result of its inclusion. This would likely lead to higher demand and price appreciation for certain segments of the Chinese bond market. In short, the Chinese bond market scale, diversification potential, and relatively attractive views make it hard for one to ignore. The fund will likely appeal to many types of investors: risk-averse investors seeking a relatively safe and low rate of return, global investors seeking uncorrelated sources of returns, or investors simply just worried about inflation eroding away their purchasing power. If you fit into any of the above investor types, allocating some of your money into China government bonds will be highly suitable. REITs also provide a high income with the potential for moderate long-term capital appreciation, making it especially relevant considering how low yields are today. Often favored by retirement savers or retirees who require a continuous passive income stream, REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. So these dividends come from the income generated by the real estate assets, which come from contracted rental cash flows. As such, investing in REITs generally provides stable, recurring dividends every year. However, this does not mean that REITs are not an attractive deal for other investors. Friendly taxation rules, steady dividend income, and long-term capital appreciation has allowed REITs to deliver competitive total returns historically. Their comparatively low correlation with other asset classes also makes them an excellent portfolio diversifier that every investor should give key consideration to when constructing their portfolio. REITs have stayed largely resilient during the pandemic outbreak due to measures taken since the GFC. When the pandemic began, overall leverage ratios for REITs were at or near their lowest on record. These precautionary measures have helped the REIT sector tide through the most turbulent year. With capital markets worldwide reopening, there is an uptick in growth-oriented M&A transactions within the REIT sector that reflect growing optimism in business models and sector outlooks. REIT earnings have also recovered substantially to about 85% of pre-pandemic levels. So having entered the downturn with strong balance sheets and liquidity, REITs are now well poised to ride the reopening wave. So a common topic of contention for REIT investors is undoubtedly the potential threat of inflationary pressures as economies continue reopening. The argument put forth is that if interest rates rise due to inflationary measures, the profitability of REITs will suffer as their highly leveraged nature will mean higher interest repayments, leading to lower returns. Theoretically, this means that investors should avoid REITs in a rising rate environment. However, in reality, rising interest rates are a result of an improving economy, which is positive for REITs as it allows them to grow occupancy rates, hike rents, and build new properties. This helps to improve revenue and cash flows. So also due to the modest amounts of gearing used by REITs as a precautionary measure, as mentioned earlier, the positive impact of a strong economy more than outweighs the negative repercussion of higher interest rates in most cases. We would also like to highlight APAC region as a stellar region for REITs, as their strong balance sheets and growing business confidence in the region makes it an attractive choice as we head towards an inevitable opening. We particularly favor the Manulife APAC REIT Fund for its heavy exposure to Singapore REITs, as our high vaccination rate makes it a strong recovery play and also a strong choice for future growth opportunities. In addition, the fund's high retail allocation offers two benefits. It is a strong beneficiary of the recovery play, which should be supported by the vaccination rate, as mentioned earlier, as well as the move towards an endemic society. In addition, suburban retail REITs provide much needed stability as they remain resilient amidst lockdown due to the clientele they service, as well as the products and services they offer. We believe that there are many opportunities in this market to be seized, both as a strong recovery play for future growth opportunities, and this is especially so for investors looking for income. And while we would like to go through each and every one of our changes in detail with you guys, that would probably mean we'll be here till next week. However, we would like to take advantage of this opportunity to highlight a series of articles on our website under the term Fund Friday, during which we have already covered some of the new funds added to the recommended funds list, including those in the 2 categories that I have already highlighted earlier. Some of the other funds were also highlighted in other articles that we have written throughout the year, including our top 5 picks for the second half of the year, so do check the article out if you haven't yet already. Don't worry, we'll be uploading an article right after this presentation, where you will be able to access the entire 2021-2022 recommended funds list, as well as links to the articles featuring these funds for your convenience as well. So do keep an eye out for that. With this recommended funds report, we hope to jumpstart investors' investing journey with this single step, given the plethora of funds we have on this platform. And investors who are finding it hard to make a decision or are new to investing may refer to the report for ideas, whether to serve as a starting point or just a manner to execute your investment ideas. So whether you are a seasoned investor or looking to take your first step, this list should serve as a guide for you to take action. With that, thank you, and now I'll pass the time back to the MC.
Thank you, Jingyan. It is soon time to announce the first category of winners of FSM Choice Awards 2021, the top selling funds. At this juncture, we will take a short break. Don't go away, and we will see you back very shortly at the awards ceremony. Welcome back. Now we honor our first category of winners. The top selling category are divided into 2 subcategories: overall top selling funds and top selling RSP funds. The award-winning funds in these 2 subcategories are what have been popular amongst FSM1 investors in the past year, according to their sales volume. Beyond that, the 3 top-selling RSP unit trusts are the ones that FSM1 investors have had the most trust and dedication in for the past year, investing in them on a regular basis, making sure of a dollar cost averaging strategy. Who are the winners? Let us find out.
Thank you, FSM1, for the kind recognition and partnership. From being viewed initially as a niche strategy amongst the broader global fixed income spectrum, the Fidelity China High Yield Fund has grown to become an effective portfolio building block for many investors seeking access to high-yielding Chinese bonds, and as a result, seen notable inflows over the past few years. The Chinese bond market, as many would attest to, is not the easiest to navigate, and fortunately at Fidelity, high-quality research allows us to understand and manage the market idiosyncrasies better. The 37-member-strong Asian fixed income investment team, 7 of whom are China-based, has given us the ability to carry out our credit research, trading, and portfolio management activities to the highest standards and effectiveness for the benefit of our investors. Once again, we thank FSM1 for endorsing the fund and to our investors for your kind support and trust through the years. Thank you.
On behalf of First Sentier investors and investment teams, thank you FSM1 for the awards. This award is a testament to the team's investment process and philosophy. At First Sentier investors, ensuring the long-term interest of our clients is at the center of all that we do. We are grateful for the trust our clients have placed in us, and we look forward to continue building on this success. Thank you for your continued support.
Good evening. On behalf of UOB Asset Management, thank you FSM1 for recognizing our funds. We are truly honored to be here tonight physically to accept this. Asian fixed income continues to be an essential portfolio allocation in anyone's diversified portfolio. With markets going through a rough period year to date, credit selection and portfolio diversification is essential in light of rising idiosyncratic risks. UOB Asset Management remains strongly committed in providing some of the best-in-class solutions for FSM1 investors, and we thank you for your continued support over these volatile times. We also remain firmly rooted to our purpose in creating value for our investors and communities, and to help them achieve their goals and aspirations. Our vision is to be a trusted asset manager in Asia, leading in both innovation and sustainability. And on a separate note, to embark on new frontiers, UOB Asset Management has taken meaningful steps since 2019 to expand our ESG teams and deepen capabilities in sustainable investments, frameworks, and stewardship. Actualizing our ESG capabilities and expertise, come September 2021, we will be announcing our latest initial offering to retail clients, a Singapore ESG fixed income product. So do stay tuned. Once again, thank you for your trust and confidence with UOB Asset Management. In these inconvenient times, I wish all FSM1 investors good health, happiness, and may you achieve your investment objectives with a UOB Asset Management fund. Good night.
Congratulations to the winners in our top selling category of awards. Our next segment is another panel discussion with BlackRock and Lion Global investors to share with us why building a globally diversified portfolio is important when investing in the second half of 2021 and beyond. It will be several minutes before we head over. Meanwhile, don't go away for too long, as we will be back with you very shortly. Welcome back. As we go into our panel discussion later, we would like to start off with another poll. To participate in the poll, firstly, click on Event Activities on the menu below this video. And under the agenda, look for poll number 2. Then click on the Join Poll button. And the poll window will be displayed on your right. Once we're all ready, we'll get started with a warm-up question. What does FSM Choice Awards celebrate? Question 2. Which of the following markets are you most bullish on? Is it Singapore, Europe, or the US? Let's see which market we are all most enthusiastic about. Over 50% of us are most bullish on the US market, followed by Europe and Singapore with 13%. Very interesting. Question 3. Which is currently your favorite sector? There are a lot to choose from: disruptive innovation, technology, real estate, financials, ESG, or others. we have a clear favorite. It's technology with 36%. With disruptive innovation and financials at an equal of 18.42%. Then real estate and ESG. Question 4, are you invested in more emerging market equities or developed market equities, or equal weightage of both? Oh, with very close percentages here, but the majority of us have equal weightage of investments in both emerging markets and developed markets. Thank you for participating. It's very interesting to hear all of your thoughts. And let us now begin our panel discussion. Moderating this session will be Mr. Ong Zi Yang, Portfolio Manager, FSM Singapore. On the panel, we have Darshan Puri, Director and Lead Product Strategist, European Equities, BlackRock Fundamental Equities. And Ms. Erica Lau, Portfolio Manager, Lion Global Singapore Trust Fund, Lion Global Investors. Over to you, Ziyang.
All right, thank you, Geraldine. Ladies and gentlemen, welcome to the second and last panel discussion of the day. Welcome, Erica and Darshan. Very happy to have you guys here in the panel with us today. The main objective of this panel really is to discuss some of the hottest topics that are up there at the top of investors' mind. Topics that our audience would definitely love to hear both your thoughts on. The topics that we are about to discuss today revolve around three main themes. First, we'll start with your respective views on inflation and what kind of timeline can we as investors kind of expect to see in terms of tapering of the very accommodative policy put out by global central banks ahead. From there, we'll lead into the respective capital market outlook for Singapore, which I will direct to Erica, and Europe, which I will direct to Darshan. And last but not least, we'll round off with the main question in the title of the segment: why building a global diversified portfolio is important when investing into the rest of 2021 and beyond, and how should our investors go about doing so. With that, without much further ado, I'll start the ball rolling with Erica on the first topic, which is your views on inflation and central bank tapering. So Erica, yesterday we saw a US inflation rate holding steady at a 13-year high, right? A 5.4% on year-on-year basis, which is the third consecutive month that we have seen inflation hitting past the 5% threshold. In Europe, we saw inflation picking up to 2.2% in July, which breaking past the ECB target of about 2%. So what's your thoughts on this, and what's your outlook on inflation ahead?
Okay. While the inflation has been elevated, the pandemic-related sectors that have contributed to the bulk of the month-on-month increase in inflation has been rolling off. So as such, we feel that inflationary pressure is temporary and that inflation would taper off as production bottlenecks ease, and also as the recovery transitions from goods to services.
All right, so how do you think that global central banks will react ahead? Will they continue to be very accommodative? What's your reaction to this inflation environment?
Under the scenario that I think that central bankers would not be forced to do preemptive rate hikes, and monetary policies will remain accommodative in the near term.
In the near term. Okay, same question to you, Darshan. So what's your thoughts on this? Do you agree with the transitory inflation theory that Erica is sticking to? Or do you think that inflation is likely to be a bit stickier or expected to be a bit longer than expected? So what's your outlook on inflation?
Yeah, thanks for the question and good evening. I think our views are pretty well aligned with the comments that Erica's made. I should caveat my comments by mentioning that I represent a fundamental equity team. So our views on inflation are very much built from the bottom up through speaking to companies rather than through looking at kind of high level macro data. But through all those conversations that we're having with companies and through the data that we're looking at from individual companies, it's very clear to us that this bout of inflation is transitory as well. It's being driven by factors like used car prices, for example, which are up double digits. It's being driven by things like elevated kind of airfares, elevated freight rates, and also supply disruption, which Erica mentioned as well. Now, partly that supply disruption is a result of inventory destocking that we saw last year. It's partly a result of disruption in the shipping markets. One stat we saw recently, just giving evidence to that, the latest point is that only about 50% of Maersk container ships are actually arriving at their destinations on time. So kind of summing that up, all of the data that we're looking at, all the conversations we're having with company management teams are pointing us to the answer that inflation is transitory.
All right, thank you, Darshan. I think that's a very insightful answer. I think on our base case scenario, on terms of house view, we're actually quite similar to Erica and Darshan. We think that it will be quite transitory, but of course we did have a little bit of a hawkish case where inflation could be, the kind of tapering expectations could be a little bit earlier than expected. So I think from there, I think we kind of established the kind of picture that to expect a hit from the macro situation. So I'll move on to the second theme, which is the outlook for Singapore and Europe respectively. So to you, Erica, Singapore has had quite a middling performance so far, definitely behind our US and Europe equities, but definitely better than our Asian peers. So in this environment ahead, what is your outlook for Singapore equities?
Right. As you all know, the vaccination rate for Singapore is at 70% now, and we are aiming for 80% by September. So with such high vaccination rate, I expect the domestic economy to start to reopen, and therefore, and ultimately, the borders to reopen as well as, globally, the race for vaccination continues. So on a 12 to 18 months time frame, I remain positive on Singapore equities. And we think that valuation remains very undemanding. So we are trading at about 35% discount to the Asian peers. You have reopening optimism, which can come anytime because we are in a process of reopening now. And then three, we also have the restructuring of corporates recently, which should generate higher returns going forward as these companies, they consolidate resources and actually invest in higher growth areas. And finally, I think that the companies that we have met and invested in, they all have shared very strong growth outlook. And I think that that provides the basis for our positive outlook on Singapore markets.
All right, thank you, Erica. Yeah, I think I saw the Bloomberg article as well, where it's quite strange how quickly we became the most vaccinated country around the world. And that kind of reopening optimism is really quite real. So what is your key strategies, or more specifically, what sectors and investment teams within Singapore are you most bullish on?
There are three themes that I'm pretty bullish on. The first is actually, of course, recovery laggards. So while we are in a process of reopening, given our high vaccination rates, right? I'm seeing a lot of recovery plays that are still lagging, and one example is actually ComfortDelGro. So this is a direct beneficiary to the ultimate domestic reopening, where activities normalize and where the nation progresses into an endemic state. However, valuations are still compelling, trading at below historical mean, and at the same time, we have added catalysts of real reforms as well as value unlocking from from listing their Australian assets. Secondly, we are also seeing bright spots in the small cap space. If you look at the small cap index, FSTE, ST Catalyst Index, that is actually trading above pre-COVID levels, and it is also outperforming the STI index. So there are a few stocks that we like in that space. They all have a very strong earnings outlook, and yet trading at attractive valuations. So examples would be Q&M Dental as well as Hourglass. And the third theme is actually restructuring. Recently, we have actually seen an acceleration of the restructuring of companies, and that has actually boosted the sentiment of Singapore stocks. But longer term, I think that companies, would actually benefit because they can consolidate their resources and look for higher growth areas to expand into, and that should generate higher returns. It is encouraging to see that a lot of Singapore companies are actually diversifying and transforming into growth areas like smart nations, urbanization, as well as clean energy solutions and digitalization. And these bodes well for these companies in the medium future. Sembcorp Industries, renewables proxy, is an example. They are aiming to increase their profit contribution of clean energy solution from 40% to 70% by 2025. And we believe that as they execute their green transformation strategy, the stock will continue to re-rate.
All right, thank you, Erica. Sounds like there's quite a lot of interesting themes. So we have the laggard sector, the small cap, as well as some of the restructuring plays within Singapore itself. So it looks like there's a lot of very value opportunity within Singapore.
That's right.
So now we'll we'll move to Europe. Darshan, so the same question to you. Europe equities clearly has been one of the leaders globally so far. Has delivered really solid returns for investors in the first half, and so much so that the benchmark Stoxx 600 is now at a record high level. So do you think that this can be sustained for the rest of the year and or even beyond that?
Yeah, that's right. And I think the simple answer is yes, the performance has been very strong, and yes, I think it can be sustained. The slightly more nuanced answer is that there is this kind of popular misconception that European equities is all about inflation and all about value. And I think some of the drivers of the rally earlier in this year has been driven by that. So some of the lower quality businesses in Europe, like some of the auto companies, for example, some of the energy companies, some of the mining companies, some of the steel makers, those sorts of kind of low quality, low margin businesses rallied very strongly up until kind of March or April. But they're in this process of seeing this big cyclical upswing, and they're on peak margins. Now, going forwards, the way to be positioned is looking at the higher quality businesses, and looking at those sorts of businesses, we're really, really encouraged by what we've been seeing in recent earnings reports from these companies. So just to give a couple of examples, one of our favorite healthcare companies is a contract drug manufacturer. So it's a big beneficiary of the big pharma companies outsourcing the manufacturing of their drugs. This company has been beating on the top line. It's been beating on the bottom line. Its customers are actually funding its capex, which is really remarkable. And this is a business where we're expecting to see high teens EPS growth for several years. So that's one where we expect very strong performance to be sustained. In other parts of the market, we're seeing similar strength. One of our freight forwarding businesses, this is a company that moves goods around the world, is seeing volumes up something like 25% year on year in its air freight business, up double digits as well in its sea freight business. It's taking market share, it's cutting costs, and again, it's beating estimates and raising guidance for the rest of the year. So that's another one where we would expect very strong performance going forwards. And then finally, in a totally different part of the market, so we've spoken about healthcare, we've spoken about freight forwarders, totally different part of the market, luxury goods, where Europe has a phenomenal heritage in this area. We're seeing, again, one of our favorite luxury goods companies just reported revenues up 84% year on year. It's up 13% on 2019 levels, so very, very strong growth. We're seeing sequential acceleration in its key fashion and leather goods business as well. So there's lots of pockets of strength across the European market. And broadly, balance sheets are in very good shape. We're seeing great capital discipline from management teams. So there's lots of reasons to be constructive going into the end of the year, albeit, I wouldn't expect the returns to be as exceptional as we've seen in the last 18 months or so since the depths of the pandemic.
All right, thanks, Darshan. So I think moving from that, you're saying that there's luxury goods and the different sectors that are really attractive. What are the key drivers, do you think, that investors right now, it's not really pricing it in yet, that they should really be paying attention to within the Europe equity space at this point of time?
So I think there's a few things. I mean, there's a couple of themes that I could mention. Again, I'll caveat that we're not thematic investors. We're very much bottom up fundamental investors looking for idiosyncratic ideas. But I could group a couple of ideas into a few themes. The first of those would be digitization. And I'm sure this is a topic that's come up throughout the evening. But some of these structural trends that we're seeing in things like automation and the Internet of Things and artificial intelligence, smart factories, smart homes, electric vehicles, all of these things are big structural drivers which are helping particularly the semiconductor industry. And Europe has a number of the global leading semiconductor companies within our universe. These are companies with very, very powerful competitive positions, R&D leadership. So that's an area of the market that we really like. We also see a number of high-tech industrial companies which are tapping into those themes as well. Another theme, if you like, could be the green transition. And again, here, we're seeing companies, we're seeing individuals, we're seeing governments all driving towards net zero ambitions or trying to reduce the carbon intensity of their respected companies or countries. And again, in Europe, we have a number of the global leaders who can benefit from these sorts of trends. So some of our utility companies, for example, are the global leaders in wind energy, global leaders in solar energy. We have a number of specialty chemical businesses which are crucial for the renovation of building stock, for example, which is a very large carbon emitter. We have building material companies who are global leaders in things like insulated panels. So again, lots of great opportunities in that sort of theme. I mentioned luxury as well, which I won't repeat. But I think finally, taking a slightly different stance on the question, and I think in the panel discussion before there was a point on this that we have kind of aging demographics. We have people who are going to be retired for longer. People need to fund those retirements, and so income investing or investing in companies which are able to provide attractive dividend yields, but these are they've got to be well-run businesses, resilient, conservative businesses, well-capitalized businesses. Those are also an attractive part of the market for specific portfolios and for specific clients who require that sort of characteristics.
All right, thanks, Darshan. I think it's quite interesting when it comes to Europe, like you pointed out that healthcare and the more cyclical oriented ones are usually the highlights of Europe, but of course there's actually a lot of other growth opportunity like your green energy, ESG, your luxury goods component because of that rising, not just your aging population, but also the rising middle income population around the world that can of course fuel that growth demand for luxury goods. So very quickly, we would like to move on to the last theme, which is why is building a globally diversified portfolio important for investing ahead? So back to you, Erica. I think in the eyes of Singapore investors, we clearly have a home ground bias. So we tend to naturally rotate towards Singapore. Mm-hmm. What are the key benefits of having exposure to Singapore equities in your portfolios?
Okay. If you can see from the past 1 year, right, the recovery has been pretty bumpy and pretty uneven. So it makes sense really to diversify across geographic regions. Of course, given the attractive valuations as well as the high dividend yield that Singapore market offers, I would recommend investors to, allocate portion of their portfolio into Singapore market. That said, I also feel that the investors should be open to diversifying their portfolio into other markets, for example, US markets. I mean, a lot of investors tell me that Singapore market doesn't really have a lot of tech exposure, and then and therefore if you want to have tech exposure, US market really have a breadth of tech companies that you can really gain exposure to. Although I also want to say that we are actually making small baby steps into improving the breadth of tech companies in Singapore. You look at the recent IPO of Nanofilm, it has done very well, and it is a good company, good quality company. And also MSCI has also added C Limited into the MSCI Singapore Index, right? That could potentially bring in more foreign listings into our MSCI Index. Potential ones will be Grab as well as Razer. So it's encouraging to see that trend, but we still need to diversify.
All right.
Yeah.
Thanks, Erica. So the same questions for you, Darshan. I think Erica has kind of spoken in the eyes of a Singaporean investors with a home bias towards Singapore equities, and obviously having a globally diversified portfolio is really important, especially in times of uncertainty. So for you, Darshan, using at this point of time, I think Singaporeans, we are more comfortable with investing in US as well as in Singapore. But when it comes to Europe equities, you guys have clearly nailed your core. Europe has done really well, and your funds, BlackRock funds for European funds have done really well as well. So what do you think are the key advantages that you think investing into Europe is for our normal Singapore investors?
Well, I think it's many of the themes or many of the things that I've touched on already, and I would probably add I would add and agree with Erica's points around geographic diversification. I think that is important. It's important not to restrict yourself to one geography. And if you're looking in a region like Europe, then there are a number of very, very attractive businesses operating in kind of niche industries, which have very powerful competitive positions, very entrepreneurial management teams, very strong cultures, which have been able to drive very attractive shareholder returns over many years. The key thing with Europe is it's very important to be selective, because if you look at the European index, it's dominated by a number of fairly unattractive businesses. So you have to look very, very carefully within the European market to find those very attractive businesses.
All right, thanks, Darshan. So with that, I've come to the end of this panel discussion. Very grateful to Erica and Darshan for gracing us with their presence today and sharing their insightful views with us. I hope everyone tuning in today will have learned more about managing your portfolios more efficiently for the rest of the year and beyond. I know I sure did. So a very big thank you to Erica and Darshan for that. Back to you, Geraldine.
Thank you to Yang, Darshan, and Erica. Next up, we will be celebrating our next category of winners and end off with our Fund House of the Year award. We'll take a short break, but remember, don't go away for too long, and we'll see you again very shortly. Now let us honor our winning funds in the best risk-adjusted returns category. The winners in this category reflects unit trusts that have performed well over the past 3 years. Here at FSM1.com, we believe it is important to analyze a unit trust performance based on a minimum 3-year track record, and hence, the unit trusts in this category were based on the data from end March 2018 to end of March 2021. These unit trusts not only performed well, but also had the ability to manage volatility and risks. Last but certainly not least, the Investor's Choice Fund House of the Year Award recognizes the asset manager that has brought about the most overall value to FSM1 investors, which includes helping them achieve their desired investment goals and rise above market volatility. Who are the winners? Let us find out.
On behalf of BlackRock, it gives me great pleasure to be here this evening to receive the Best Risk-Adjusted Returns European Equity Award at this year's FSM Choice Awards. We would like to thank IFAS and the FSM1 team for recognizing the strong performance of BlackRock BGF European Fund and the deep expertise and capabilities of our European equity investment team. We would also like to take this opportunity to thank all investors in BlackRock funds. As a fiduciary to investors and the leading provider of financial technology, we from BlackRock hope that by using our solutions, we will help more and more people in Singapore experience financial well-being. Thank you very much and stay safe.
We are deeply pleased and honored to receive this award from FSM1. On behalf of Lion Global Investors, we would like to thank FSM1 and our investors for their continued support. Our achievement has been made possible because of this confidence in the Lion Global Singapore Trust Fund all these years. 2020 was a challenging year. The COVID pandemic resulted in intense market volatility, and to win this award amidst such market condition means a lot to us. This award is a testament to the team's hard work and consistent performance. Looking ahead, we are positive on Singapore equity market. We believe Singapore is well positioned for growth on recovery opportunities in a post-pandemic world. Once again, thank you for placing your trust and confidence in Lion Global Singapore Trust Fund. We wish you good health and please stay safe.
Thank you, FSM1, once again for the recognition of our funds, this time in the equity category. The past 2 years has been difficult for investors as markets dealt with the volatility brought about by COVID-19 over and above the fundamental challenges encountered by businesses worldwide. Amongst these conditions, it is important to note again how fundamental research plays a part in sieving out longer-term winners from losers, and in doing so, we aim to provide our investors with optimal risk-adjusted returns. Particularly for the Sustainable Asia Equity Fund, this core Asian equity strategy is not just built on Fidelity's strong research expertise, but also on the firm's wholesome ESG engagement approach, which has been well integrated in our research process. It is our belief as a firm that as we carry out our day-to-day research activities to generate value add for our investors, we can simultaneously influence positive change to the companies that we research and invest in by engaging them in areas where sustainable practices are concerned. We will continue doing our part for the industry, and we thank FSM1 and our investors for your confidence and endorsements. Thank you and best wishes.
Hi, I'm Priscilla Poon, Institutional Sales Representative with Wells Fargo Asset Management Singapore, a business unit of Wells Fargo Bank NA Singapore branch. We are so honored to be awarded Best Risk-Adjusted Returns US Equity for Wells Fargo US Large Cap Growth Fund by Fund Supermart Singapore this year, and also to be included in the recommended funds list for 2021 and 2022. Being recognized by Fund Supermart Singapore is an honor, and we look to deliver a best-in-class experience to our clients in Singapore. The Wells Fargo US Large Cap Growth Fund offers a power of long-term compounding through investing in businesses on the right side of change. The team believes that innovative companies with superior fundamentals are frequently mispriced in the equity markets. As a result, the long-term growth prospects of such companies are commonly misperceived. Through intensive fundamental research, this mispricing is the key anomaly that the team seeks to exploit through its investment process. A special thanks to Fund Supermart for recognizing our investment capabilities, and to our US equity team for producing excellence in the Wells Fargo US Large Cap Growth Fund. On behalf of all of my colleagues at Wells Fargo Asset Management, thank you for this award.
I'm Jacqueline Goh, and I oversee the retail distribution arm for the Singapore Funds business at JP Morgan Asset Management. On behalf of our firm, we would like to thank you for your kind support over the years. It is truly our honor to be receiving this award for our JP Morgan China Fund. JP Morgan's history in China began in 1921 with the opening of an office by one of our predecessor firms in Shanghai. That laid the foundation of a century of investments, insights, and on-the-ground research. This award is truly a recognition of our global expertise and unrivaled investment capabilities in the region. Our JP Morgan China Fund seeks to capture the best quality and growth opportunities in both the onshore and offshore Chinese equity markets. Our China equity strategies are formulated through disciplined fundamental research coupled with bottom-up selections. We have investment teams located in Hong Kong, Shanghai, and Taipei, cultivating collaborative partnerships with local experts in China through the sharing of knowledge and insights. As of the end of June, the fund has outperformed its benchmark across virtually all time periods, whether it be 3 months, 1 year, 3 years to 5 years. Since its launch on 31st of March 2005, the fund has delivered annualized return of 13.8% with excess return of 2.1%. Amid the global recovery, North Asia has emerged as a key focus for some investors seeking growth. China takes the spotlight with relatively attractive long-term investment themes in its equity markets. Growing domestic demand, import substitution, and technological advances are likely the key considerations for investors seeking to optimize China's potential in their growth portfolio. We thank you once again for being on this journey with us and look forward to your continued support.
It's been 20 years since we've established a working relationship with FSM1, and thanks to the support of all of you out there, we have been able to grow together with them and you. The award for the best risk-adjusted returns in Japan equity demonstrates that value and growth can be found in all places, even in Japan equity, which hasn't had much love from investors for a good number of years. We firmly believe that as good investors, we need to be able to filter out the macro noises and focus on the strengths of the businesses which we invest in. Thank you for voting us as the Fund House of the Year, especially this year as we transit from First State Investments to First Center Investors. Just as we've had a wonderful growth journey with FSM1, we trust that our clients also had a wonderful investing journey with us. Here's looking forward to continued support from all our investors. Thank you.
Congratulations to all winners. We are now coming to the end of FSM Choice Awards 2021. But before you go, we would like to let you know that you can celebrate with us with our Unit Trust promotion. From 12th to 25th of August 2021, receive $10 worth of bonus units for every $10,000 invested in any of the 11 winning funds from FSM Choice Awards and 45 recommended funds. To find out more, head over to our website, www.fsm1.com. And with that, thank you for joining us at FSM Choice Awards 2021, and good night.